All right, why don't we start? Well, thank you all for joining this webinar today, and also for posting your questions on the registration form. That was really helpful. I think it is a great time to discuss this topic of why now the time is right to invest in distressed debt. We've seen, of course, lots of media headlines. The market is down quite significantly. S&P is down nearly 12% year to date. Nasdaq is down 20%. So it is, I would certainly say the time is right to hear today from Don to talk about this topic. Interestingly, despite all the cracks that are showing and despite the market downdraft, only 25% of you have indicated to have an intention to invest in this space over the next few months till year end. So Don, I think there's still quite some convincing to do during this webinar. As many of you will have seen, Don is very experienced in this space. He has more than 30 years of experience in high yield and leveraged loan and distressed markets. He's the founder and CIO of Credit Value Partners, a specialist manager in high yielding and opportunistic private credit markets. Prior to that, he was the global co-head of leveraged loans, CLOs and distressed debt at Credit Suisse, and prior to that at DLJ. And actually after that, he was the global head of the credit investment group at Credit Suisse Asset Management, which actually in 2011 did a spin out of Don's team, which is now Credit Value Partners. Don and the team have put together a number of slides which are including and in addressing all the questions that you have posted. I would say if you feel that any of your questions are not addressed or if any other questions come up, please feel free to interject. I think you have, well, we've tested it already. Your mics should be working, so please feel free to ask a question, or you can raise your hand, or if you're more comfortable posting your questions by chat, that can also be done. We're planning about 30 minutes for Don to speak about this topic. He said he's happy to talk for about an hour and a half, but we'll limit it to about 30 minutes, and then we'll leave about 10 to 15 minutes or so for direct Q&A. So with this, I will pass it over to you, Don.
Okay, thanks, Patrick. Can you hear me?
I can hear you loud and clear.
Yeah.
Can everybody, all the attendees, can you hear Don well? Maybe a thumbs up, Christoph?
Yeah,
yes,
perfect.
okay, perfect, thank you.
Okay, all right. Well, thanks everyone for joining. Thanks, Patrick, for the introduction. As Patrick said, I put together some slides here, and really, I think the slides are going to address a number of the questions that were presented. You know, I prefer to kind of go through it this way with the slide deck because it gives some background on the market, gives you an idea of how we see the market shaping up this time around, this new default cycle shaping up, how we're approaching it. And so I think a number of the questions that were presented will be answered through the deck. But as Patrick said, you know, please feel free to ask questions. Probably better along, you know, toward the end, but so that we don't go down too many tangents here. But if somebody really wants to point something out or have me address something on a particular slide, go ahead. So here we go. Here's just a little bit of background. You know, as Patrick said, I've been doing this for quite a while. I actually was this slide here encompasses my career. I started as a LBO banker in the mid 80s, and the market kind of blew up in 1990, 91 and created a big distressed opportunity. And then I switched over to trading distressed loans in 1991. So participated in pretty much this entire chart, which is really 3 full default cycles, and then the COVID crisis, which was much more of a dislocation that was fairly brief. What you're looking at here in the purple is the high yield bond index, and what you're looking at in the blue is the leverage loan index, and then the green is the CCC loan index. So this is data from Credit Suisse, and on the left here, these are prices. So what you can see, you know, and what is really worth, you know, focusing on getting your head around is how cheap things get when you go into these default cycles. So the high yield index in each of these 3 default cycles traded down into the low 60s, and during the financial crisis, even the high 50s. So the average high yield bond was trading down 40 points. And the reason we highlight CCC loans, we actually focus more on syndicated loans than high yield bonds. There's a number of reasons for that, but CCC gets even cheaper, right? So the average CCC loan during the last 2 default cycles traded down into the 30s. And so it gives you an opportunity to buy senior secured debt, or in the case of high yield bonds, unsecured debt at very big discounts to par, setting you up for very attractive returns, as long as you've picked reasonably good companies. So as we say, we look at the market as clearly a cyclical strategy, but when these market dislocations and default cycles are happening, you want to be aggressive, you want to be accumulating a portfolio, and you want to stay in the market and continue to invest and recycle capital. So that's the other thing. You can see how long these cycles are. I think people, just because of the COVID crisis, forget that, default cycles, big market dislocations, typically play out over a number of years rather than a number of months. And what happens in a typical default cycle is you have new companies that are defaulting each year. So you have you're basically turning your portfolio over. During a good default cycle, we'll turn our portfolio over 2 to 3 times as we enter and then exit investments. And so I will show you here. This gives you a sense. I'm sorry, I might have passed over one. This gives you a sense again of just these market cycles. This is just a different view of it. Shows you a little bit more detail based on rating. So if you want to think of a safer asset class in the leveraged corporate credit markets, it would be BB loans. And if you wanted to think of something that, is really distressed or trades at distress levels, it would be CCC. So again, CCC in the green, BB in the blue. And you can see that, BBs are pretty resilient, and they are a good place often to kind of take safety as you're going into new default cycles and waiting for prices to correct. That's kind of where we are today. So we're in safety, we're focused on income generation right now. But as the markets dislocate, as things get cheaper, we rotate out and we start to buy and accumulate portfolios of distressed at much better prices. Down here, by the way, this is default rates. So default rates for leverage loans and for high yield bonds. The leverage loans is the lighter color. And you can see how default rates, spike up during these default cycles. The other thing you'll notice is the gray bars here. Not such a great view of it there, but you can see it back here again. Every default cycle coincides with a recession, including the COVID crisis. A lot of people think that it's the recession that actually creates the default cycle, and that's not really true. As you can see here, default cycles start well ahead of recessions typically, unless there's a real shock to the system and it comes on quickly, as it did with COVID. But what recessions do is they actually contribute quite a bit. They contribute quite a bit to the default cycle, and they extend the default cycle. So what happens in default cycles is people are taking losses on credit. They start to rotate out of credit. You start to get withdrawals, redemptions, the banks stop lending, the risk managers take over. And that credit tightening basically becomes a real problem for leverage companies. And so as more companies during the course of the cycle need to refinance their debt as their debt comes due, more of them default. And that's why you have these long default cycles, these multi-year cycles that really create a nice long, cyclical investing opportunity. This is something that we did, just going back and back testing. This was back to 2018, so we need to update it and kind of capture the COVID crisis, but it gives you a sense. Someone asked, when do you know it's the right time to allocate to distressed and invest in distressed? And based on my experience, I sort of say, if you really want kind of a benchmark to pay attention to, I think it would be the high yield bond spread to worst. And if you were to start to invest in distressed when the high yield bond index spread to worst was trading at 600 over, and then you exit, or you fully exit that portfolio when your high yield spread to worst goes back under 450, these would be your returns in distressed debt over that full period, 1990 to 2018. So you would have caught a few cycles during that period. These would have been your cumulative returns in the distressed asset class. And then it compares it to the S&P 500, and it compares it to the Barclays Ag, and then the Schiller Home Index, just to give you a sense of how well distressed does during these default cycles. If you wanted to generate even higher IRRs, you could start to invest when the spread to worst goes through 750. And you will see that you can actually accumulate even higher returns. However, if you're really, you'll generate higher IRRs, but your cumulative returns are actually better if you start, this is back testing, at 600 over. So I don't want to get too technical, but if people ask, hey, what are you focused on? We actually do look at the high yield spread to worst, something you can look at every day. By the way, currently it's trading at about 480 over. So technically, even though the fixed income markets, including high yield's down about 7.5% year to date, but that's not because spreads have widened out. It's more, they have widened a bit, but it's been more, just related to duration risk and the impact of rising interest rates. This is another thing, that we highlight here, which is, a lot of people, quite frankly, wait too long to allocate to distressed. And the point of this chart is to just show how quickly distressed markets can develop. There's really, in our opinion, two elements of a typical default cycle in the investing opportunity for distressed investors. The first is a market dislocation, and then the second is more of an organic default cycle that plays out over a number of years. And the dislocation typically happens pretty quickly, and these red lines indicate a high yield spread to worst of, in this case, it's 450, okay? So you can see when spreads start to widen out, and this is kind of where we would be now. Again, this captures a little bit of the COVID crisis, but you see how quickly the markets can deteriorate. That's a good time to be accumulating it, because in some cases, many cases, you can see how quickly the market starts to recover. This again is the broad high yield index. The triple C's would be a little slower to recover, and they would dislocate even further. But the point being, again, that you really do want to, these are prices up top and these are spread to worst down below. You really don't want to wait. Our experience with some investors, especially larger institutions, is that they decide to allocate after the market has already dislocated. It takes them months to get their approval, and by this time, they frequently will miss, a good part of the recovery, especially when it happens quickly, as it did during the financial crisis or following the financial crisis, and COVID as well, which was even quicker in terms of the recovery. This, gives you a sense. What I'm going to do here is just kind of compare a distressed debt strategy to equities and where you want to be, when the markets dislocate. So as you can probably imagine, or as you may have experienced, the markets correlate, quite strongly during these big market dislocations. So as the equity market is dislocating, you'll often see the high yield credit markets dislocating. It's basically that risk off mentality. People are basically getting to the sidelines, redeeming on their equity funds, redeeming on their high yield and leverage loan funds. And so you get these sharp sell-offs, these high correlations. The gray line here is equities, and this goes back to 1998. So this captures the dot-com crisis. This captures the the great financial crisis, and this would be the COVID crisis. But what I'm pointing out here, and I'll show it on the next slide as well, is how long it can take for equities to recover versus how quickly credit recovers. You tend to get, and there's good reason for it, and it's particularly, you can see it here during the financial crisis, how quickly high yield and leverage loans recovered, and then it took several years for equities to get back to new highs. So point I'm making is it has been a great asset class to take advantage of just broad market dislocations and corrections, if not bear markets. The credit markets tend to recover more quickly because people get back on their front foot. They take a look and they say, especially with leverage loans, we're buying the senior secured debt, we're well protected by assets, we're earning a good current coupon, and there's a maturity date which basically defines when the company has to create an exit for us. And you don't have that obviously with equities. So equities, there is no sort of due date for the equity markets to recover. You're also junior in the capital structure, so there has to rebuild a case for the enterprise value being higher. And so again, I think when people are taking a look at what's happening in the markets now, equity markets have corrected strongly. You're just seeing the credit markets, credit spreads start to widen out. We think that's going to continue, and we think that the credit markets, distressed credit is a great way to sort of play the overall market opportunity here. The sell-off that's evolving right now. This again gives you a better sense of how long it can take the equity market to recover to new highs. So again, this is that whole theme of some people would argue you just stay invested and power through it, but with very low dividend yields, coming into this correction, I think the S&P dividend yield was around 2.5%. You're not really getting paid for it, and it takes you, in many cases, several years to get back to new highs. So, as we see it, a better strategy is to cut losses, look for the markets to correct, capture the opportunity through the debt markets. This again just gives you a sense of these last 3 default cycles, not including the COVID crisis, which would be here, and the kind of returns that were generated by distressed debt. This is the HFRI Distressed Hedge Fund Index, and CCC debt, the high yield CCC index, and how they compared to the S&P 500. And again, the returns are very attractive relative to other asset classes. And so distressed debt, stressed and distressed debt tends to do very well. So as we looked at, these prior default cycles, I would just like to highlight 6 things when you're thinking about distressed debt and the opportunity of the asset class itself, some of which I've pointed out, but it's cyclical, and not surprisingly, default cycles follow multi-year corporate leveraging cycles, so basically LBO cycles. So what happens is you get into an LBO cycle, you become progressively more aggressive, and leverage multiples pick up. People push the envelope. In some cases, you're buying less quality companies, and essentially you start to see defaults happen. And then the defaults, again, start to take over the mentality, and the sentiment becomes, let's reduce risk. And that credit tightening then starts to accelerate a default cycle. And it accelerates as you get the outflows, it pushes prices down and accelerates the correction. And so what tends to happen, as we discussed earlier, is recessions. So default cycles coincide with recessions. Default cycles, as we just discussed, are long. A lot of people, again, recessions are much shorter than default cycles. The average length of the last 3 default cycles was 65 months. So over 5 years, whereas the length of the last 3 recessions was 10 months, the average length. So default cycles, great. You get in, you stay in, because it's still a really nice opportunity to keep recycling. Default cycles are large. So this is some data from JP Morgan that they put out on the last 3 default cycles, and they characterize them, I think correctly, as most people would, the savings and loan crisis that happened in the late 80s, early 90s, the tech collapse, also known as the dot-com bubble, and then the great financial crisis. But in each of these, you'll see cumulative defaults of high yield bonds kind of extraordinarily, reached over 30% in each of these cycles. So a third or more of all high yield debt defaulted in each default cycle. And so I think when people read all the articles that come out now, Bloomberg does regular updates on default rates and things, we're at or near historical low default rates. But what happens is when you get into these default cycles, they tend to accelerate really quickly, and then they have tails to them. And so by the time you get through a 4 or 5 year, 6 year, in the case of the financial crisis, default cycle, you see about a third of all companies default on their high yield debt. Someone asked the question, what's the difference between this cycle that's coming up and prior cycles? So these are the factors that I see playing into this next default cycle. And I've got some slides following that sort of reinforce these points. But quickly, we now have just a record amount of leveraged corporate debt. So in the US, there's now $5 trillion of high yield bonds and leveraged loans outstanding. That's more than double the amount that was outstanding just before the financial crisis hit. So it's a huge market, $5 trillion. What you also have is lower rated companies, particularly in the syndicated loan market. So sponsors have been pushing leverage. The market has been taking it and accepting that. And so the rating agencies have basically been the only, sheriff, if you will, objectively rating these companies. And what you've seen is that the leverage loan market pre-financial crisis was about 2/3 BB minus or higher rated companies. Today, 2/3 of the leverage loan market is single B plus or lower. And as I'll show, a third of the leverage loan market is now rated B minus or triple C. So it's not that they're worse companies, it's just, people have piled more leverage on them. So that will translate into more, well, a couple of things. It'll translate into more forced selling, and I'll show that because the CLOs are very rating sensitive. So as you get downgrades, as we go into a recession, you'll see more forced selling. And the other factor is you'll just see higher default rates. Default rates for lower rated credit are much higher. Double B credits default at about a third of the pace of single B credits, for example. The other thing that's going to play in is that there's more liquidity amongst investors, which is, generally a good thing for investors, but for the market, it presents risk. It's made the markets more volatile. So the several loan and high yield bond ETFs and daily liquidity funds, will contribute to sort of a lemming mentality when we do start to get more panic in the markets, which has happened, every prior default cycle. You get an inflection point and then panic selling. But the market is now more subject to it or more vulnerable to it because of all these daily liquidity funds. There's also less dealer support for the markets than there was in prior default cycles. That's a product of the Volcker rule. If you go to any, I ran the trading desks for the loan trading and high yield trading desks for Credit Suisse. And, back in the financial crisis, we had deep pockets to actually support the markets and, create bids for loans and bonds that we had underwritten. Most trading desks now have very low trading limits. And in fact, they tend to be the first sellers getting out ahead of market pressure. So they actually add to, generally what we've seen is that they add to the price pressure and to the dislocation momentum. A really important part, though, that we focus on now, if you go back and you look at the great financial crisis, you look at the COVID crisis, both would have been much worse. Both would have been even larger default cycles. and they would have been even larger market drawdowns, market losses, had the Fed and the Treasury not gotten actively involved in both. They did so for good reason. Obviously there was systemic risk with the financial crisis. The whole banking system was coming unglued. And then with COVID, you had just an economic crisis as the economies were shutting down. So they stepped in and put in trillions of dollars of support. The question is, are they going to do that this next time around? So when you look at the financial system, it's actually pretty well capitalized. When you look at the economy, at least the US economy, you've got relatively full employment. You obviously have an issue right now with inflation, but and the Fed is stepping in, ironically, not to liquefy the markets, but actually to do the opposite. So you now have the Fed leading credit tightening, whereas during the financial crisis and COVID, they came in and provided massive liquidity to the markets, which abbreviated those two default cycles. So I think that's going to be a major theme as we go through this next default cycle, lack of government support. I think this will be more like the dot-com crisis, where basically the Fed and the Treasury just stepped aside and let the markets do what they did, and equities corrected by over 50%. Here, factors that might mitigate a larger default cycle, as we go into this next default cycle, there's lots of money on the sidelines, right? And so there could be more price support. It's not going to come from the banks and investment banks, but it's going to come from opportunistic investors. It'll come from private funds. A lot of money has been raised. There's a lot of money with private equity sponsors as well. So one of the estimates that I saw, $1 trillion right now of undrawn commitments with the private equity sponsors. I think that'll be important on a case-by-case basis for providing support for individual companies that are sponsor-backed companies. The other thing that'll probably mitigate actual credit default rates will be covenant-light loans. So, now in the syndicated loan market, I think it's over 80% of all syndicated loans are covenant-light. So in prior default cycles, a lot of companies would default on covenants rather than payments. Now that you have covenant light, you're going to have less covenant defaults, obviously. And so I think overall default rates will be lower. That gives the sponsors more time to kind of come in, and potentially wait for the economy to recover and allow the company to, kind of bridge a recession. They can step in when they want, anytime with more support. But what it won't do is it won't mitigate downgrades. So as you go into a recession, as earnings decline, you're going to get higher leverage ratios, obviously, and you're going to get the downgrades. And the downgrades create forced selling. So these are just some charts, that highlight the points that I was making. This is the leveraged loan market, the high yield bond market. It doesn't include revolvers and term loan A's for the loan market. So the loan market, as I mentioned earlier, $2.5 trillion today. High yield bond market's about $1.5 trillion, so $4 trillion. The private credit market, direct lending market, is now estimated to be about $1 trillion, so $5 trillion market. It's just a massive market. And so when you think about dry powder, a lot of people say as you get into defaults, you probably will never see lower prices because there's so much money on the sideline. They're not really focused on the fact that it is a $5 trillion market. So every 1% default rate is creating 50 billion of new distressed debt. In every default cycle, default rates have gone to double digits. So, you could well see 500 billion, $1 trillion, again, over the last 3 default cycles, cumulative defaults being 30% or higher. You could see well over $1 trillion of defaulted debt or downgraded debt, which creates the forced selling, which creates a nice opportunity for distressed investors. And this is just leverage ratios and buyout multiples. So sponsors paid more and more and more for companies as we went through this last leveraging cycle. Leverage ratios through the senior secured debt, the first lien debt, are higher than ever, as you can see here. And total, is basically at or right on parity with the pre-financial crisis leveraging cycle. So a lot of leverage credit. You can see here the effect of that additional leverage. it's what I referred to earlier. Anything yellow is a single B credit, rated credit. This is the leverage loan market. Red and orange are B- and triple C. Blue is double B or split single B, double B. Green is double B and split triple B. So what you see, where we are today is 2/3 of the market being single B plus or lower rated credit. Much different than pre-financial crisis. So much more vulnerability of default. I realize this chart's a little hard to see, but basically, single B- and triple B rated credits. This is over a 3-year period, defaults. So triple C's, have close to a 50% likelihood of defaulting over a 3-year period. Single B- is somewhere in the mid-20s. Much different than when you're looking at double B credit. So there's so much weaker rated credit, it should contribute to a larger default cycle. We talked about this, this is more transitioning to the timing. When does the next default cycle start? I think it's already started. All the ingredients are there. You've got massive amount of leverage corporate credit. The credit markets are clearly contracting right now, trading down. As I mentioned, credit spreads are widening out, not extremely so, but they're up, for the high yield market, about 100 basis points from where they were toward the end of last year, and you have the Fed leading credit tightening. And every time that the Fed has raised the Fed funds rate, it has led to a recession. This captures the last 30 years, but if you can go back 80 years, and that's the case. So credit tightening really, just as credit expansion, fuels economic expansion, credit tightening creates economic contraction. And so, I think the cat is out of the bag here. In all likelihood, at some point, if the economy does start to go into recession, the Fed is very likely to reverse course yet again and tighten or expand credit and, start to cut rates again. They've done that in the past, but they have not been successful in putting, a lid on a recession once they've started to tighten credit. And this just shows, again, the Fed's plans for shrinking their balance sheet. So, they expanded it dramatically, as everyone knows, since the financial crisis. And then in particular, as we got into the COVID crisis, the Fed expanded its balance sheet by $4 trillion over COVID, over a 2-year period. It fueled markets. This is the S&P 500. It correlated quite nicely to, much higher equity values. It created, a great rally in leverage corporate credit, massive inflows into direct lending, et cetera. And there's every reason to believe that as they tighten and they shrink their balance sheet by trillions of dollars, you will start to see pressure coming the other way. And so that's something that obviously we're watching closely.
I'm just conscious of time. You've spoken for a little bit more than 30 minutes, and we probably have 10 minutes left or so. I think we should probably continue with, because you have a few more slides. So maybe if you keep this pace, then we can fill the next 10 minutes. But are there any questions from the audience at this stage, or should Don just continue?
So why don't I give it,
maybe just continue. Yeah, sure. Go ahead.
Yeah, I'll do a few more, and then we can cross over to any questions that weren't addressed here. But this just shows, as you get into recession, what happens to corporate earnings. It's what I alluded to earlier. So it's as you would expect, economic recession, you get an earnings recession. What does an earnings recession do? It elevates leverage ratios on already levered companies, and therefore you get a wave of downgrades. That's a real problem, for rating sensitive investors. And then what you also get is maturing debt. So somebody asked the question, whatever happened to the wall of maturities? Quite honestly, it's never been bigger, right? So you've got a record amount of non-investment grade debt coming due over the next 4 years. And so if your earnings are down if the capital markets are closed, as they typically do during recessions, or they're highly constricted, you will see these companies default on their debt as their debt comes due. Maybe they can make it until their maturity date thanks to covenant light, but as maturities come due, there's really, no way to kind of wiggle out of it unless the sponsor comes in with additional support. Here's the downgrades that I was referring to, and these are defaults, and you can see they elevate during recessions, but you get big downgrades. You had a huge amount of downgrades that happened in COVID because, again, credit was very weakly rated going into COVID, even weaker today, and the rating agencies got out after it, and that creates a problem for the CLOs. CLOs dominate the leveraged loan market in the US. There's about 750 billion of CLOs in the market today. And so, they really can kind of control what happens in the markets. And to be frank, they create great opportunities for distressed investors. The typical CLO can't carry more than about 7.5 or 8% CCC rated debt. As you go into default cycles and downgrade cycles, they pretty quickly start to violate that. You can see the average CLO today holds about a third of their total portfolio is rated B3 or lower. And so these B- or B3s are very, vulnerable to downgrades, and that creates a lot of forced selling from the CLOs. So for investors like us that focus on the syndicated loan market, it creates a real windfall. You have a lot of forced selling of triple C rated loans, good companies, but over levered, and it creates a terrific opportunity. The other thing that happens is the CLO market during the financial crisis basically closed down. And you need the CLO market to stay open because it regenerates itself. CLOs, terminate their reinvestment period. They need to put a new CLO together to actually create liquidity for the liquidating CLO and for new issue as companies refinance their own debt. So this created a lot of pressure during the financial crisis. If and as this market evolves, this kind of market correction and defaults, you'll start to see the CLO market shut down, which will create some real pressure. So this is the last one I'll talk about here, but this is what I referred to earlier. This is everything in the market. The only asset class that's kind of held in was the syndicated loan market. It's just about flat on the year. That's really been the beneficiary of inflows from everybody getting out of fixed rate credit. Everybody escaping duration risk. You saw a lot of inflows to loans, but as you start to see credit losses, we expect to see significant outflows of loans and for the loan market to correct as well. So you can see fund flows here. You can see the impact it's had on credit spreads, which have widened out. But again, things won't get interesting, or typically don't get very interesting for us until the high yield spread to worst crosses 600. So I'll take a pause there. We covered a lot of ground. We'll share, a bunch of these slides with you as well. I'm happy to answer any follow-up questions as you look at the slides that we didn't address here. But we'll open it up for any questions or anything that we didn't cover that you would like us to.
Thanks, Don. I've got a question. What for you would be, as a distressed investor, the biggest risk that this default cycle would not happen?
The risk
why wouldn't it happen? Yeah.
Why wouldn't it happen?
Yeah.
Yeah. Okay. Yeah. I mean, it's a great question. The biggest risk is that the Fed does decide to step back in again, the Fed and the Treasury. It is, and if they step in and reliquify the markets, as we saw, during COVID, that's been pretty powerful in basically abbreviating and reversing default cycles. So you kind of have to ask yourself, do they want to do that? I mean, if they do that, they would be feeding inflation, which is kind of the number one enemy, inflation and unemployment, number 1 and 2 enemies of the Fed. That's their mandate, is to control inflation. And if they come in and reliquify the markets, they would just be feeding it, which is why we don't think that would happen. But that to me is the biggest risk. Away from that, it's pretty clear that the economy is weakening right now. The U.S. economy is unique because 70% of the U.S. economy is consumer spending, driven by consumer spending. So inflation's a real problem, and it's starting to weigh on the consumers. You can see it if you pull up consumer sentiment data. And so I personally believe, we're heading for a recession, and at the same time, you've got this problem of rising interest rates, which has created a lot of pain for investors here, and weighs heavily, rising rates weigh heavily traditionally on the stock market. And so I think investor losses will result in more, outflows as people start to cut risk.
Great, thanks.
Don, thank you. Can you explain to us the liquidity when you are in the cycle? You say you rotate your portfolio 2 to 3x. Who are your counterparty? What's your strategy in the distress? Are you buying, let's say, conservative distress or distress? And how do you manage liquidity?
So, the slides that we didn't get to are, my recommendation, which is to invest in syndicated loans. Not surprisingly, it is our favorite asset class, but syndicated loans trading at stressed and distressed prices, and there's reasons for it. And reason number one is the one that you just asked about. There's actually pretty deep secondary market liquidity for syndicated loans, even during default cycles. A lot of that will come from CLOs themselves as they're swapping different CCC rated loans, lower rated loans. So they're in the market actually buying, but net they tend to be net sellers because they have to stay within their limit. The other buyers are clearly the opportunistic guys like us, but we need to generate 20% plus returns. That's our target in stressed and distressed debt. So we need to buy it cheaply. So you do see that big gap down that I showed on the opening slides of where CCC loans trade. They tend to trade down to very low prices. But once you're invested, if it's a good company, you're taking it through a restructuring or you're giving it additional liquidity. And I'll just kind of highlight, this was during the COVID crisis, and this wasn't a proper default cycle, but it was a big dislocation. The leverage loan index traded to the low 80s, not cheap enough, but individual cases. We bought the first lien loans, syndicated loans of about 23 companies. You can see almost all of them B- or CCC rated. So the CLOs were the sellers for the most part. And our average purchase price was in the high 50s for first lien syndicated loans, right? So you're topping the cap structure, you protected your downside, and you're set up because you bought it at very cheap levels. You're generating good current income. You can see the coupons here, and since you're buying it so cheaply, your current yield is much higher. And then as the market recovered, again, this was extraordinary because it was a market recovery, but as I showed in earlier slides, the broader market tends to recover pretty quickly for credit. And so if it's a good company, you'll start to get the recovery. And this is where we were able to exit these. And so our average exit price was in the 90s. You're in the 50s, you're out in the 90s. You're generating an IRR of 40% in a 12-month period. And so, to be honest, that is where we are focused. We like the syndicated loan market because it does have liquidity. It's got and it's got that downside protection to it.
Just if I may, so does that mean that on the up cycle, your buyers are CLOs mostly, or?
On the upcycle, it's a combination of different buyers. So as the company recovers, and especially if you took the company through a restructuring and deleveraged the company, so sometimes the sponsor will come in and support the companies and reduce leverage and extend maturities and things. Yeah, the CLOs are typically the buyers, right? So they'll be the buyers. In deeply distressed situations, we'll often, again, restructure the company. You get post-reorg equity in the company, so you convert the debt to equity. You cram down the existing equity holders. And in those cases, we're often selling that equity to control-oriented distressed investors. So there's some distressed investors that want to accumulate a majority stake in the company. We're more of a for influence investor. And so we like that. We're very active in the restructurings, but once the company's no longer distressed, we're happy to trade out of it and recycle the capital into new distress situations. Other guys want to, are more private equity oriented. They want to buy the entire company. They have a much longer investment horizon. So we're often selling to those guys, or all of us that hold that post-reorg equity are selling that equity through an IPO or an M&A process where we just sell the company, and that's our exit.
Thank you.
Yeah. I did, want to highlight one thing, because there's been so much focus and so many inflows going into private credit, which many people define as direct lending. Direct lending is just one form of private credit. Syndicated loans are obviously also private credit. There's big differences in the two of them, though, in default cycles. Private credit has grown from a $200 billion market to now $1 trillion during the post-financial crisis period. So direct lending hasn't seen a default cycle yet, a proper default cycle. It's going to be very interesting to see what happens, over this default cycle, because direct loans, unlike syndicated loans, don't really have secondary market liquidity. There's one or two or maybe a few holders of direct loans. So it's harder as opposed to us, if we're in a loan and of a company and the company starts to deteriorate, we can sell the loan. There's secondary market liquidity, we can cut risk, right? On the flip side, as an investor, we're able to accumulate portfolios of distressed loans by buying in syndicated loans in the secondary market. You can't, and I showed that, with that portfolio of 23 companies we accumulated during a short period over COVID. You can't really do that in the direct lending market. It's more of you're making a loan at or near par and you're earning a nice coupon and you hope it works out. But if it defaults, you're not really able to cut your risk, you're riding through it. And what complicates it even more is most direct lending funds use leverage. They use portfolio leverage, at least one turn. So most of those, unless they issued bonds, which some of the bigger direct lenders have done to finance themselves, if they're getting their leverage from banks, they typically will have mark-to-market margin calls on that leverage. And so what we saw with some lenders during the financial crisis, and this also happened with CLOs that were ramping up new CLO warehouses, the leverage providers would hit them with margin calls as the loan market was trading down. And in many cases, the managers lost their portfolios to the leverage provider. And so you are exposed to that in the direct lending strategies. On a name by name or credit by credit basis, both benefit from sponsor support. Almost all direct loans have sponsors that own the equity, and over 60% of all syndicated loans are sponsor-backed companies. So the sponsors can, step in and support the company. But there's a very big difference. I guess the point being, direct lending is not really a way to play the distressed market. The only part of it, sub-strategy within direct lending that would be applicable, is providing new money loans to distressed companies. Bankruptcy dip loans, exit from bankruptcy loans, new liquidity loans. That's something that we do, So any company that we own and we're taking through a restructuring, if they need additional liquidity, we will provide a new loan. And typically it's the holders of their, pre-petition distressed loans that will provide that new loan to the company. They tend to be lucrative, very high coupon, very well secured, and you have a vested interest in making sure that you're providing the loan so that somebody's not stepping in front of you with regard to your claim to the collateral of the company.
Don, I think that's very helpful because, sort of the consensus focus is certainly within credit, certainly very much on the direct lending space. So thanks for pointing that out. Are there any more questions? Because we've gone over a little bit over the time that we had set ourselves. But I'm assuming that everybody has been very interested and following closely what Don is saying. Are there any more questions? Maybe we have room for one more question. And if not, then maybe we'll close it off. Any more questions, anyone?
Maybe one. Well,
Tijn, okay, thank you.
Question. Quite often we at a certain point in time we see really stress in the market and the sell-off, but till now it's like we're sliding, and no one really is aggressive in selling or something. Do you know what could be one of the causes that we will end up in such a situation, or could it just be that it will be more like a looming situation?
Yeah, it's a good question, because this is evolving more slowly than what you saw in the financial crisis and what you saw clearly during COVID, right? But if you look at prior default cycles, the two big ones before that, again, this is the S&L crisis, this was the dot-com crisis and default cycle. They evolved, look at this. I mean, they're really, the market started to sell off in 1988 and didn't actually trough until, early 1991. And in this case, the market started to sell off 1988 and 91. Here, during dot-com, it started to sell off in, 98, 99, didn't actually even trough until 2002, 3, right? So you didn't have as much panic selling. You didn't have as much of a broad dislocation. I don't know, this time around, you clearly had it during COVID. You had it during GFC because you really had systemic risk, as we talked about before. I think, as we got into, GFC started at the end of 2006 with losses in subprime. But as they started to actually, as people began to realize how big a problem that was for the banks and investment banks that held massive mortgage portfolios and the losses, you then saw a big dislocation, right? And that basically kicked off when Lehman went bankrupt and the markets deteriorated very quickly. I don't know this time around, obviously COVID evolved so quickly and it became very clear that it was going to shut down entire economies as nobody could go to work. I don't really know what factor, might develop this time around. If the war escalates in Europe, that could certainly be it. But I think what we might be seeing is just more of a evolving, default cycle. And as people take more losses, more people decide to exit the market. I don't know that we're going to have that big capitulation point that'll, very quickly take the markets down, by another 20, 30%. It could just be more of this slower, painful grind as we go into a recession, as corporate earnings decline and everything that you see, with recessions.
Great.
Perfect. Well, maybe we'll close it off there. I'd like to thank all the participants for joining today. Of course, Don, I'd like to thank you especially. Perhaps good for the participants to know that Don is currently fundraising for his fifth vintage fund, where he generated nearly 18% or over 18% last year. Final close will be in September, so if you are interested, let me know. It is a 5-year closed-end vehicle with actually, very interestingly, an option to invest in an evergreen share class as well. So let me know if you want to receive the marketing materials or any of the market intelligence research papers that Don produces. There will be a recording of this, which I'm happy to send also. Don, thank you. And for all the other ones, also thank you for participating. I really enjoyed it. Thank you, Don.
Yeah, thanks everyone. Appreciate you joining us.
All right.
Thanks a lot.
Bye.
Bye-bye.